everybody's been asking, everybody's been wondering, both agents, buyers, sellers, the news media, what's going to happen moving forward in the market. Things are getting somewhat scary according to some people, and should we be looking out for a crash? Well, I've had the same questions, very similar to most of you, and I wanted to operate out of fact and not fear. So before I really make my assumptions, I wanted to look at the data and see what the data actually told us was happening. And so I went back 20 plus years of data. I spent about 6 months compiling everything and about 2 weeks making everything in a presentable format and figuring out the best way to present the information, and then just waited on a time for it to be the right time to present the data to those that needed it. And buyers and sellers are going to do their thing with the way that they're going to talk. But when agents start getting loud about it as well, it's time to make sure that we get educated, and it's time to make sure that we're informing the public correctly and based off of fact, not off of our opinions, not off of our assumptions, but off of what we can prove and what we can accurately talk about with the market. So everybody's been wondering what's about to happen. What is about to happen? Things are getting a little crazy right now. Pricing's kind of going nuts. Interest rates are doing this, they're doing that. What's about to happen? So to really understand what's about to happen, we have to look in the past and figure out what occurred previously that's got everybody so freaked out. So let's talk about one important thing, and that's the subprime mortgage market. The subprime mortgage market was basically a market where loans that couldn't get approved for normal conventional standards, and these are things like poor credit, poor income, shaky job situations, recent foreclosures, repossessions, and they would take those borrowers and figure out a product that would still work for them to still get them into a home. This was done during a time of little to no regulation, and buyers that probably weren't able to get a loan or shouldn't have been able to get a loan were getting loans, and they were doing it through a variety of different ways, a variety of different products. Some of those products are CISA loans, stated income, stated assets, SEVA loans, stated income verified assets, NINA loans, no income, no assets, my favorite, Ninja loans, no income, no job, no assets, and no doc loans. Basically, the borrower just said they could afford it, and the lender or the bank said, okay, cool, that's awesome. So specifically want to call out two different types of mortgages that were really prevalent, and keep in mind, this is like 2001 to 2007. Really prevalent during that time. Those are the balloon mortgage and the interest-only payment mortgage. The balloon mortgage had a low intro payment. It typically had a 5 to 7 year term on that rate, that lower payment. And then when that term was over, whatever was decided on before, whenever that term was over, a lump sum payment was due. That's not 3 or 4 months worth of payments. That's the entire chunk that's left at that time. So there's only two ways out of that loan. You either refinanced out of that loan or you sold out of that loan. When the market's taken off, when the market's hot, interest rates are really low or dropping, that's fantastic. Refinance or sell it. You're good either way. When the market starts teetering a little bit, homes aren't selling as quickly, or pricing starts dropping, interest rates start coming up, it gets a little bit harder, especially if you've not been making much towards your down payment or towards your principal. And that's what the interest-only payment was really dangerous about, was that you were only paying the interest portion of your payment. So people were getting approved based upon this low interest or this low payment, and the hopes of everybody was, they'll just be able to refinance out of it. The market's doing fantastic, pricing's going high, interest rates are still low. They'll be able to refinance it no problem. In worst case scenario, they'll be able to sell. So let's go ahead and get this. Found some data that said that during the years of 2006 and 7, maybe even all the way to 2008, interest-only loans were 18% of all loans generated. Crazy, crazy numbers. Does anybody see a problem with those types of loans? Right? Craziness, absolute craziness. So we have to look at context and figure out, okay, well, why did they do that? Because when we look at it today, we say that's absolutely insane. How could they ever do that? Why would they ever do that? That's so risky. Well, you have to look again back at that subprime mortgage market. Well, what was happening is they would take these subprime mortgages and they would package them together, put a credit rating on them, and sell them to investors. And the investors would buy because there was basically guaranteed cash flow off of those mortgages. They would buy those as an investment, and that cash flow would come to them. And how it got as tricky and as complicated as it did is that those loans would get sold multiple times. And banks started getting really deeply involved. Investment banks were getting really deeply involved. So when the cracks started showing up in 2006, midsummer, basically 2006, when the cracks started showing, everybody started trying to figure out a way out of it, but everybody was so deep they couldn't. The market started to level, maybe even start coming down a little bit, things getting a little bit shaky with interest rates, and people couldn't get out of those loans, so those loans stopped performing. Well, when those loans stopped performing, the cash flow wasn't there to be able to fund that basically that business of the investor. So when one cracked, they all started cracking. When they all fell apart, they all fell apart. So how they did that, they didn't care necessarily about the income, the jobs, the assets, like we just talked about. The only thing that really mattered was the credit score. As long as they had a good credit history, the assumption was that will continue. They didn't necessarily look very hard at the debt to income ratios. Not every bank, at least. Some I'm sure were doing their due diligence and only approving loans that should get qualified. So what happened? Well, everybody that's in this room and everybody that's watching, if you're in the industry, you know the market crashed. And if you've not been living under a rock, you also know the market's crashed if you're just a buyer or seller watching this as well. So the market crashed, and I wanted to take some time to really look back and figure out, were there key indicators? Were there things that we could have seen coming? And why didn't we stop them? And what can we possibly do moving forward? There's 4 indicators that I found. There's interest rate, there's population change, there's the amount of distressed properties coming onto the market, and then there's unemployment rate. All 4 of those things showed a very strong correlation to either price, to the velocity of which things were selling, or the overall market condition just in general, good or bad. So let's talk first about interest rates, which is the big elephant in the room. Interest rates have risen rather quickly here lately, and there's a lot of people starting to talk about buyer affordability and buying power. Very valid concerns. Let's look at why. When you look at the chart, you'll see interest rates have had a general trend downwards over the last 20 years, with the exception of 2006, 7, and 8, where we got above that trend line a little bit, where interest rates started to come up a little bit from where they were. Not much, but they came up a little bit. Pricing then continued down. COVID hit. They dropped interest rates even more to keep the market going. And then, you look over here at 2022, and in that column, we're seeing a large jump above the trend line. That's what's got everybody concerned. That's what's got everybody talking, is it's such a drastic change from where we were that, of course, it's going to cause issues, right? Of course, it's going to stop the buyers from being interested. Of course, it's going to slow down the market. Well, what I found was that there was no real correlation between high interest rates and lowering of pricing. Because when you look back at the years 2001 to 2008, yes, inflation was higher or as high than what we are right now. Pricing continued to go up. So if we're looking at 2022 and we're saying, okay, interest rates went up, buyers have to stop buying, right? Well, history shows us that that's not necessarily accurate. It could be, but it's not necessarily accurate. What I did find is that interest rates, when lower, definitely caused pricing to go higher. We saw that in COVID. Interest rates, hit below 3. House prices went nuts because the demand was so high that people were willing to pay crazy amounts above asking price and above whatever the appraisal was to be able to get into that home. Demand was so high that the market just took off on price. So we've got interest rate. Let's look at population. What's our population done since 2001? Population has seen a steady increase from 2001 to 2022. When you look at the numbers and you break those down, we've had a general and an average growth rate of about 2,000 people per year, or 12,000 people per year, I'm sorry. 12,000 people per year coming into the market on a consistent basis, year over year over year. Well, whenever I started pulling this data, I looked at the raw data in Google Sheets and Excel, and I thought I was seeing some interesting things. You know, the data was there, and I saw some larger numbers, some smaller numbers. But it wasn't until I put it into a visual that I really saw that data come alive a little bit. So we've got a trend line going across of consistent growth and a percentage growth for the market. Well, when you look at 2001 to 2008, we were going well above that curve, almost like a bubble, right? Now, population growth isn't necessarily bubble crash, but it's just interesting how the data played out whenever I formulated this chart. You'll see that the population was way outpacing, and we were growing about 16 or 17,000 people per year during that time over a normal of about 12%. The interesting thing was in 2009 to 2010, we lost 22,000 people. Gone. No longer in Northwest Arkansas. So what happened, right? We know something happened, but what was it? Well, 22,000 people left. When you break that down to say, okay, well, cool, 22,000 people left. What does that actually mean, Landon? Well, let's look. 22,000 people. You take that divided by the average household size of roughly 3. You divide that by the number of people, or you multiply that by the percentage of homeowners versus renters, and it comes out and spits out a number to you and basically says 4,300 and some odd homes possibly came on the market that one year that would not have normally come on the market. So when you look at 4,300 homes come on the market that normally wouldn't have been there, what do you think is going to happen? Does supply-demand get out of whack a little bit, right? So let's look at something. Well, what was really going on? Let's look at the distressed properties. The data only goes back to 2009 for our MLS, where distressed properties of foreclosures, real estate owned, short sale possible, short sale approved, court ordered, all of those things, when you look up those trigger terms, it only goes back to 2009. Well, obviously, we didn't have much of a problem beforehand, but what happened in 2009 that caused them to say, hey, let's make this a searchable term, a searchable filter? Well, from 2009 to 2010, we had a major increase in the amount of distressed properties that we had come on the market. 33% between 2010 and 2011. When you look at those 2 years, when you take that and say how many distressed properties were there and how many sold properties were there, 33% of every home sold was a distressed property. That was mind-blowing to me. I couldn't believe when I saw that data how high that percentage was. 33% of every home sold. And it took a little bit for that number to come back down, but when you look at our situation now and you compare that to what occurred then, and everybody's trying to say that we're going to have the same thing happen, well, our distressed properties is less than 1%. Less than 1% of every sale is distressed. Well, there's some studies out there. There's the Mortgage Brokers Association has some data out there that's basically stating home ownership equity is at an all-time high. At an all-time high, meaning the amount that you owe on the property versus what it's worth is at an all-time high. We're in a good spot when it comes to not seeing distressed properties come on. And if we did see distressed properties come on, it would have to go way up for a bunch of stuff to come on the market and have much of an impact. So why did distressed properties come on the market? Okay, we lost a bunch of people. Distressed properties came on the market, so a story's starting to formulate a little bit. Well, unemployment happened. When you look at us as a general market, this is Northwest Arkansas only. You know, in general, we've really been 3.5% probably on average, but the numbers get skewed a little bit higher, and that trend line's a little bit higher because we had such a crazy time, 2009 to 2012, 2014. Unemployment was higher, and this is per year average. I'm sure there were times where this number was way higher, but when you look at the per year average, you're seeing these numbers way above where we're at today. One thing I want to point out is 2020, COVID. That's what that is. When you see that column go above that trend line, that's not necessarily a huge trigger to say, oh my gosh, everybody freak out. What that's saying is that COVID hit, a bunch of people got laid off all at once, unemployment claims went through the roof, then over time it came right back down and we're in a good spot. We've got an unemployment in our area of about 2.2%. We're in a very, very fortunate area. We have fantastic employers in our area that are very, very strong. So unemployment is significantly lower now than what it was. An interesting thing of note is that when you look at the unemployment rate in the distressed properties and you overlay them, you'll see that unemployment is a leading indicator. Okay? A leading indicator is basically like what it says. Unemployment occurs and something happens later, right? Unemployment happens, then something else happens from that. Distressed properties, on the other hand, don't just pop up out of nowhere because there's a foreclosure process, there's a distressed sale process. Those don't just happen, something happened prior to that. So unemployment and distressed properties are directly related, and you'll see a very strong correlation between the immediate rise in interest or in unemployment and your distressed properties coming back behind it, right? 2009, when distressed properties became a searchable filter in our MLS versus the actual unemployment rate, you'll see about probably 6 months, 7 months after that occurs, after the unemployment spikes, distressed properties start to spike. They're directly correlated. So all of that being said, that's what's happened in the past, and let's look forward to price and what's happening today. So price. When I went through this information, I wanted to make sure that I filtered it somehow, because whenever you go back 20 years and you look at every sale that's occurred and you start downloading it and putting it into sheets and really chewing through that data, I needed to narrow it in a little bit by city, by some other search terms, and ultimately it came up with about 98,000 properties is this data that you're about to see. About 21 years and 98,000 properties. So the search parameters, just so everybody's aware and we're all on the same page, I filtered it out to where I believe 80% of the business that we're doing today is really occurring. The things that you're going to be selling on a regular basis, let's narrow that in. Let's not go to the extremes. Let's just focus in a little bit. So I broke it down by city to Bella Vista, Bentonville, Centerton, Cave Springs, Fayetteville, Lowell, Rogers, and Springdale, what I call the Big Eight. Okay? Basically I-49, a little bit east and west, the Big Eight. Property type was only house, condo, townhome. No distressed properties. I didn't want that messing up the data, especially when you get into the 2010, 2011 zone. I didn't want that to mess up our numbers too much. Our bedrooms and bathrooms were 2 to 10. So it has to have a couple bathrooms, has to have a couple bedrooms, so we know it's a livable property and sellable. And then the square footage was from 1,000 feet to 10,000 square feet and no more than 10 acres. So when you look at average sales price since 2001, we obviously have seen ourselves continue to rise. Okay? We're continuing to rise and we're actually picking up the pace. And what's got some people concerned, and maybe for good reason, we'll find out a little bit more as we go and as we break this down. When you see an increase in price, you have to say, okay, well, that's kind of what happened in 2005 to 2007, right? 2008. And the same thing going to happen? We're going to crash. Well, let's look. As a general rule, we've been trending up. Well, what happened in 2006 to 2008, you saw that we broke past, when you adjust price for inflation, we broke past that trend line. Well, if we broke past there, well, what in the world's going on now? Because we're way off of it now. We're going way above it. So obviously, if we're way above the trend line, pricing has to come down because we crashed in the past, right? Maybe. Let's look at it. What's got everybody concerned is that last year we were at about $340,000 for this specific search criteria as an average sales price. And according to the data that I pulled, I couldn't hardly believe it when I pulled it. The average sale that's occurred this year for that search criteria is $408,000. Now, I don't necessarily think that that number stays. There may be a few large homes or several large homes skewing that data, but it was still about 3,500 sales. So we should find some consistency. So it can't be that far off. So $408,000. Well, that's what's got everybody talking. Our pricing's going kind of crazy. Our interest rates are going kind of crazy. We're going to crash. That's what everybody's telling you. That's what the media is telling you. That's what other agents are starting to talk about. That's definitely what buyers are saying, because they're waiting to buy for the right time, and sellers think that they can still get a fortune for their home. So, we're all stuck, right? So if everybody's talking about the fact that in 2006 to 2008 we started breaking that trend line, and then 2020 to 2022 we started breaking that trend line, let's compare those few years here. So the real increase in price occurred prior to the crash between 2003 and 2005. So when you compare 2003 to 2005 to now 2020 to 2022, we had roughly a 41% run up between 2003 and 2005, 41%. Well, 2020 to 2022, we're at over 50%. Anybody starting to catch this a little bit? So we had a humongous run up prior to the crash. We're on a huge run up now. They've got to be the same, right? Same thing's going to happen, right? Well, what's got everybody so freaked out? That. Between 2009 and 2011, prices dropped 11%. So if it was a 40% run up to an 11% drop, what do we think is going to happen when it's a 50% run up? How bad is the drop going to be then? That's what people are talking about. That's what people are afraid of, especially the ones that have been in the business for a little while and they've seen their businesses got real shaky if they were in the business then, right? So that's why they're talking. So let's zoom out a little bit. Let's get a little bit more context. Let's not look at necessarily the worst 3 years and the best 3 years. Let's zoom out just a little bit and see what actually happened. What would have happened to a buyer? So we'll run a scenario here. Unlucky buyer number one bought at the absolute worst possible day in 2008. Okay? Then they sold at the absolute bottom of 2011. The best day to possibly buy and the worst day to possibly buy. This buyer did it. Unlucky buyer number one. What happened? Well, no surprise, we just went over it. They lost roughly 11%. Okay? They panic bought and they panic sold. They lost big. Okay? Well, let's look at another buyer that maybe didn't have to sell, maybe didn't panic. Maybe they had a fantastic real estate agent that was talking to them and reaching out to them and making sure that they were aware of what was happening in the market. And maybe that person took them through something similar to what I'm doing now, which is an in-depth education about what's going on. Maybe that agent did that. So what happened to unlucky buyer number two? Well, they bought at the exact same time as unlucky buyer number one. The same day. It's crazy. They even closed at the same place. But they waited until the end to the middle to the end of 2012 to sell their home. They didn't panic. They waited. What happened? Well, they only lost a little bit more than 0.5%. We weren't back by any means in 2012. But by waiting a little bit, by having a little bit of patience, maybe this person had knowledge, maybe they were empowered by a real estate agent, they didn't panic. Does everybody see how panic can hurt you on the buy side and the selling side? If you listen to the noise, you're going to get caught. Operate out of fact, not fear. Let's look at everything, okay? One thing that I really find interesting is absorption rate and what people consider to be a seller's market, a balanced market, and a buyer's market. A buyer's market is typically 90 to 100 days or less. A seller's market is typically 90 to 100 days or less of inventory. A balanced market, according to a lot of people, is 12 months to 180 months. Or I'm sorry, is 120 days to 180 days. And then anything beyond that is more of a buyer's market. Okay? I don't feel like we're that much different in Northwest Arkansas. I do think that there is some adjustments that need to be made to those numbers, but we'll just kind of run with them. So let's talk about absorption rate. Absorption rate is the rate of sales over a given period of time divided by the number of active listings, available inventory. The number of sales during a certain period of time, we'll call it 12 months, so 1 year, 3,000 sales happened. Divide that number by the number of months, so 12, and then take that number and divide it into the number of listings that are active, and that gives you how many months of inventory you have. Well, I can't stand it when people say we have 2 months of inventory. Because when I say 2 months of inventory, does that mean like 1 day over 1 month, and that's, quote, the second month? Or does that mean 1 day less than 3 months, and that's 2 months? So I break it down further, and I go to days. I want to know how many days of inventory we have. So when I pulled this information, there were 616 active listings. And I broke it down by what was absorption rate over the last year, the last 6 months, the last 60 days, or the last 90 days, and then the last 30 days. So when you broke all of that out, we basically hung right around 27 days of available inventory. Okay? 616 active listings, 27 days of inventory, meaning the market will consume those listings, those 616 listings in this search criteria. They'll consume it in 27 days if nothing else comes on the market. And the other thing that we can look at is the number of pending sales in the last 30 days to see, are we going to continue next month that same pace? Well, we have 620 sales pending as of this data. So still less than 1 month of inventory. Okay? That's not a lot, in case you're wondering. That's so little inventory still today that when you compare it to the rate of sale for every other year, we have to go all the way back to 2015 before we get to what some consider to be a balanced market, more of that 120-day zone of a balanced market. So little listings that even the rate of sale in 2015 was barely the threshold of what some consider a balanced market. So we are multiple times below that, and this is a very much still a seller's market. Now that's going to change a little bit, that's going to shift, but right now we are in a very strong seller's market. So here's what has to happen if we're going to crash. Available inventory needs to come way, way up. A lot. A lot of listings need to come on the market all at once. Or buyer demand needs to come down. And in my opinion, both have to occur. Inventory's got to come way up and buyer demand has to come way down before we start seeing a crash. Unemployment needs to go through the roof. Okay? People need to start getting laid off left and right. It can't just be a housing market crash. It has to be a financial crash similar to what happened before. Not a recession, a crash. Recessions occur about every 7 to 10 years. Historically, that doesn't necessarily constitute a crash. What happened in 2008, 9, and 10 was very much a crash. Okay? We have to see a lot of things happen for it to return to that. Lastly, population needs to have negative migration. Remember back in 2009 and 2010 when we lost 22,000 people? Well, that happened because unemployment went up. When that happened, less buyers were in the market, so buyer demand went down. Foreclosures came on the market, so it was a perfect storm. So for us to do that same thing now, all 4 of these have to be true at once for us to crash. Not necessarily for price to come down, but to crash, what everybody's freaked out about, what you hear about on the news and what you hear about between buyers and sellers and other agents, maybe even the one sitting next to you watching this, for us to crash, those 4 things have to be true. So here's what's likely got to happen. Here's what's likely going to happen in our market. You'll see interest rates continue to rise, and they'll put pressure on home affordability to combat inflation. Okay? The government and the Fed are actively trying to curtail pricing inflation of homes on the market and homes sold, because the price of homes is a major contributor to those inflation numbers that you're hearing about on the news, on TV, on Facebook from Aunt Jenny. And those inflation numbers can be kept in check if home pricing flattens to come down or comes down. And they're trying to do things to cool it off a little bit. So I don't see that stopping. Northwest Arkansas is still going to be listed as one of the best places to live in all of America. Okay? That's not going to change. We have great jobs. We have what most consider to be great weather, where you get to experience all 4 seasons. We have great schools. Our housing is affordable. That's not changing, at least not immediately. Northwest Arkansas will still be one of the best places in America to live. Buyer demand will continue to stay strong, but we'll revert back to buyer demand more in line with 2015 to 2019. That doesn't mean we'll sell the same amount of homes as then, because remember, our population has gone up. If our population goes up, that means there's more homes that need to be consumed every single year as a percentage. So you'll see the amount of homes sold higher than that range, but the demand, the amount of home sales per population, per 1,000 people, that rate will be more in alignment with that time range of 2015 to 2019. So what's likely going to happen, and what I believe we'll see, the rate of price increase is going to level off, and I believe it's going to level off rather quickly. And what I mean by pricing leveling off is the list price to sales price ratio. The days of selling for 110, 112% above asking price are likely gone, with the exception of a few pockets in Northwest Arkansas, and I believe we all know where those are, where your pricing is going to continue to be hot, it's going to continue to stay strong, but it will level off. It will start coming back down to normal. And then over the next 18 months, I believe that you'll start seeing a further shift more towards the downturn of home selling for about 2 to 5% less than asking price. That doesn't mean I believe pricing is necessarily going to come down. What I think is going to happen over the next 18 months is it's going to take time for sellers to really understand that their 3-year-old home in Rogers, in Southwest Rogers, is going to sell for 120% of what it's actually worth. It's going to take some time to convince people that we're in a different market and we need to pay attention to the math and what the data tells us we can get for that home versus what we think we can get for that home. And I think agents will be somewhat handcuffed by their sellers. And in order for that agent to get that listing or keep that listing, they need to temporarily appease that seller at their price point before you start seeing pricing a drop in their asking price. That doesn't mean that they're selling for less than what it's worth. It just means that they're selling for less than what they thought that they could get. So I think we'll be more in that 98 to 95% zone. Does that make sense to everybody? Okay, good. You'll see the return of incentives from builders. This is a big one. Every house in Northwest Arkansas right now is getting spec'd out, right? That's happening for a couple reasons. Buyer demand is so high and so crazy that the builders don't care. If your buyer doesn't want it, they'll sell it to somebody else. Does that make sense to everybody? Everybody in agreement that the builders aren't necessarily doing anything wrong. They're doing what they have to keep selling and going fast. But I do believe that you'll see a return to builder incentives. It's going to take some time. What's going to happen, I believe, is that with builders specifically, with new construction very specifically, is we'll start seeing quite a bit of new construction come back on the market for 2 reasons. The buyers aren't reaching out to the lender, and the lender's not reaching out to the buyer. Why would they need to do that? Okay? The reason why they need to do that is because they contracted 8 months ago. Well, interest rates have gone up quite a bit in the last 8 months, right? So has their payment. Well, if they didn't get to lock in their rate 8 months ago when they started the contract process, they had a discussion with the lender. The lender said, oh, yep, your payment's roughly going to be this. We'll just have to lock your rate later. We can't do it right now. So what happens is, if they're not communicating when all of this is occurring, when all this price increase is occurring, they're not communicating until it's time to lock in that rate. Well, when it's time to lock in that rate, they finally get to see what that price is going to be, and listen very carefully. They may not want to afford it. Did you catch that? They may not want to afford it. What you see a lot of in our area is that people can afford the debt-to-income ratio. It's still fine on their debt-to-income ratio, but they may not want to pay that. Even though they can, they may not want to. So I don't think you're going to see a massive crisis when it comes to new construction, but I do believe that people will start backing out of new construction when they start finding out what that price is going to be. They think it would be a better option to rent. Okay? So with those return to builders incentives, that means things like maybe getting a fence when a builder says today, no, we're not going to do that. Well, if supplies come back around and they're not selling homes as quickly, maybe you can start asking for fence. Maybe you can start asking for some small customizations inside the home, right? Not just being limited to, hey, pick this backsplash, pick this paint color. And you can only do that in the first 4 days after contract, right? So we'll start seeing some things come back, and it's gonna be nice, right? You may even have some seller credits there, some builder credits back to you. But I don't believe that you'll see price come way down to get deals to close. I don't believe that. I think that they'll just add things into the home like they used to 2014 to 2019. They had to do a little bit of extra work for us to get those things closed out, right? The last thing that builder wants to do, especially if they have lots left in the neighborhood, the last thing they want to do is sell for less than what they've been selling, because that means every house from then on they're going to sell for less than what they could have gotten. So they would rather add things to the home than drop their price to protect the homeowners and their reputation with those homeowners, and protect the validity and value of the rest of the neighborhood as they continue to build. You'll also see buyer's agents get a minute to actually look at a home. We'll actually be able to walk into a home, schedule an hour on showing time. It's going to be awesome. We'll get to actually take time inside of a home and formulate a great offer and think about things. We'll be able to negotiate. It's going to be fantastic. We're going back to what it used to be. Not crisis, not crash. We're going back to what it used to be. You'll be able to ask for things like closing costs. You'll be able to negotiate repairs. Maybe you have a house to sell and you can actually get it under contract. Somebody will accept a contingency. I can't believe it. That's going to come back, okay? Be ready for it. Listing agents, start preparing your sellers for that truth. That is going to happen. Start preparing them. Don't let it be a shock. Don't put yourself in that position. Don't put the sellers in that position. And don't allow a deal to not occur for lack of information and lack of a hard conversation. Okay? So at the end of the day, I want to leave you with this. You and your buyer are going to be just fine. You and your seller will be just fine. Stay focused. Cut out all of the noise. Be confident. And stop being afraid. Live in fact, not fear. Thank you.